Hey everyone, it's Dan the Joyful Trader here. Have you ever wondered how much money it actually takes to get started trading options effectively? How much do you really need to start with to begin to generate a meaningful income? Because I hear that a lot. So about a year ago, several people had written to me with a challenge, and that was to open a brand new account and demonstrate what could be done in a year's time. So I do a lot of trading with Tasty Trade, among other brokers. And I opened another account with them and I funded it with $20,000 of real live money. And I pulled my first trade on August 1st, 2024. Nothing simulated at all. I chose to trade it using my favorite and most consistently profitable strategy, which is the short strangle on futures contracts. So these results that I'm going to talk about contain no cherry picking, no home runs, just steady and consistent trade returns. So today is July 27th, 2025. So I'm almost a year into this test, and my actual return has been 119%, being totally derived from consistent wins, again, not from any one big home run. Currently, my net liquidation value stands at $43,244.72, and the cash value in the account is $49,150.59. So today in this video, I'm going to show you the real results, talk about my rules, my basket of candidates. I'm going to walk through every single trade, every mistake, every lesson that I learned, and the valuable statistics that were derived over the course of this last year. So, without any further delay, let's get into it. Okay, why this challenge? Well, people always ask me, can I start options trading with $2,000 or $5,000? Well, the truth is, yes, you can start trading options with a small account, even as low as a few $1,000s. However, the reality is that many strategies, especially those involving multiple legs or undefined risk or just having access to slightly higher price stocks, they quickly run into margin requirements and capital constraints. So having at least $20,000 really gives you the flexibility to diversify, manage risk a lot more effectively, and access a wider range of opportunities without being forced into only the cheapest or the narrowest of trades. So I would encourage you, if you want to start trading options seriously and you only have a few $1,000s, focus first on building up a savings account of, say, at least $10,000 before you start. It will just give you much greater advantage to access a wider variety of strategies and instruments for your trades. So I started with this account fresh to illustrate what can be achieved. No tricks. My only goal was consistency. My personal trading style and my goals are to achieve consistency. I am the opposite of a YOLO trader. I want to trade in a way that my statistics reinforce that what I'm doing works over time. It reduces my anxiety and it builds confidence. I remember my trading mentor used to say, and I teach this too, that when you begin to consistently take profit each month and trading becomes boring, then you know you're doing it right. Traders that live for the thrill of the trade usually do not last that long, in my anecdotal opinion. Strive to get to the point where trading becomes boring. You know what I mean. So with this test, I didn't want to hit home runs. And although they're great when they do happen, I'm more interested in steady and predictable monthly returns. I just wanted to grow this thing reliably and show what's possible with a small but reasonable account size. And also, I'm going to share with you the PDF of all of these trades that shows every detail of each of these trades, plus all of the averages from the year. So check out the link below in the description, and you'll be able to get a copy for yourself to examine. Easy peasy. Okay, so here's the setup. Here's what I traded. Natural gas, live cattle, Euro Forex, the Australian dollar, British pound, crude oil, micro E-mini, the 30-year bond, copper, gold, and lean hogs. These are very liquid, optionable futures with decent premium and consistent, fairly predictable seasonal price movement. Additionally, there's enough diversity within these instruments so that I can keep most of my trades as uncorrelated as possible. And yes, even natural gas and crude oil are not all that correlated. Normally, I'm okay having trades going in both of these at once. So again, my strategy is to focus only on short strangles, selling a put and a call at safe distances, usually around 9 or 10 delta on each side. Most of these trades were opened within a 45 to 60 data expiration, and I'm looking for trades that will give me around an 83% probability of profit, zero delta, with an average ROI of around 15 or 20%. Basically, I get the biggest bang for my investment dollars trading strangles on these instruments than I would on most stocks. The capital efficiency on these futures is extremely good, and the margin overhead required is far less as well. I held these trades for about a month, with an average being 29.5 days. The average capital I needed per one lot trade was around $1,033 initially. And that amount does rise usually after your trade is open, so you need to make sure to leave plenty of headroom for that expansion in your account. I never commit more than 40% of my total account size in margin when opening trades, and that's among all the trades that I have going cumulatively. I'll show you the accurate details of what my year-long statistics truly were on this account. I'll show you all the trade logs, my wins, my mistakes, no disguises, no overblown hype, just full disclosure, which I hope you find educational and inspirational. Okay, before I enter any trade, I follow a strict checklist. I aim for 45 to 60 days till expiration. I usually set strikes that are around the 10 delta mark on both sides, sometimes a little bit wider if volatility is high. I always check the IV rank. I'm looking for, about 30 and above. I always check the seasonality of the product. I research also to make sure that there are no major binary events coming up, like inventory reports or Fed announcements or other kinds of data which are pending, which could significantly impact it. It doesn't mean that I won't take the trade. It just means that I might have to adjust for a bullish or a bearish bias in anticipation. I just do what I can to prepare. In this account, I was usually only trading 1 to 3 contracts on average per underlying at a time. I don't overstack correlated instruments either. Once I'm in, I set a target limit to take off the trade at 52% of max profit to close the trade, and I rarely hold all the way to expiration unless the trade is just coasting. The reason I choose 52% is it just helps me to account for fees and commission is all. You can set it wherever you like or straight 50%, but I find 52% accounts pretty well for most of my commission and nets me my 50%. If things move against me, I don't panic. I monitor the delta, the profit and loss curve, and I decide whether to adjust or exit based on various defined triggers. This rules-based approach is what's kept my results very consistent and my stress level low. I can tell you that I have not adjusted or rolled any of the strikes, though, on any of these trades in this last year. Now, even though I aim for about 50% of max profit, I don't treat that like a rigid rule. It's more of a target. There are times when trades earn, say, 30% to 40% of its max profit within the first 10 or 12 days. Sometimes even within the first 1 to 5 days. And so at that point, it just makes sense to take it off. For example, if I collected $1,000 in premium, and so my profit target would be, say, $500, and the position is already up $350 within 1 week with another 50 days to expiration, and the underlying hasn't moved much, I would probably just close that trade and move on. Why? Because the risk left in the trade outweighs the reward left to gain, especially if theta decay slows down and gamma risk starts to build up. So if I've got a quick win in a product like that, I'm happy to ring the cash register early, take the money off the table, and then redeploy the capital somewhere safer. It's not about squeezing out every last dollar. It's about compounding smart wins over time. In fact, I may even immediately open a brand new trade in that same instrument, just starting clean. So remember that with strangles, every day that you keep the trade open is another day of exposing yourself to increased risk. Taking 50% of max profit is statistically the sweet spot of when to get out, because again, gamma and other Greeks will begin to creep in, and as the days to expiration get closer, token losses become very magnified and they can catch you off guard. So I'll show you how that happened here on one of my trades that I wasn't monitoring very well. Hey, by the way, if you've been watching my stuff and thinking, man, I wish someone could just walk me through all of this option stuff step by step and explain it to me in a way that makes sense, well, I built exactly that. It's a course called The Beginner's Guide to Options Mastery. And it's an outflow of over 10 years of personal mentoring that I've given to real friends of mine and colleagues in and out of the medical community that I work in. This course is made for folks who want a full picture, how options actually work, how the pieces fit together, what the terminology means, what the implications are, and how to use them without getting lost in the weeds. I see far too many people jump in trading options way too early, and they invariably lose on each trade, and then they end up not fully understanding why. So I keep it super approachable, no fluff, just real talk between you and me using clear examples and common everyday terminology. And so if this course sounds like something that you think would help you to become a better options trader or just to get started, go ahead, check it out at www.thejoyfultrader.com. All right, let's get back to the conversation. All right, so I am in my spreadsheet in Google Sheets that I've used to track all the trades for this particular account. And like I said earlier, I'm going to go ahead and make this available for anyone to download and take a closer look at and check how I've made my trades and what I'm logging and all that good stuff. Column A is the status, and I use this little pull down to tell me, what the status of the trade is currently. And B is the opened date. C is the underlying that I'm trading, and I can talk about those quickly as well. D is the put call strikes. So these are the actual strikes that I chose. Expiration date of the strikes. The DTE at the time that I opened the trade. So this tells me how many days. The current DTE, this calculates automatically if the trade is still open. Like I have some trades that are still open down below here. And so you can see I've got 34 days, 54, 55, etc. Days held so far. This is 23 and 9 on these open trades. And when the trade is closed, then this all gets filled in. I have the percent of holding time. This basically tells me when I close the trade, how much of the DTE did I have to wait in order to close the trade. So in this trade, I waited 84% of the 99 days. This trade down here on row 6, I waited 17.9% out of the 67 days to expiration that the trade held. And this is the next column over is just a little graph that kind of shows me that. I keep track of my probability at profit when I open the trade. I keep track of the IVR when I open the trade. And then this column, I keep track of the maximum premium that I received when I opened the trade. This column tracks 50% of that maximum premium, so I kind of have an idea of what my target is. And then column O tracks how much capital is required to open the trade in each of these instances. So you can kind of see how much capital I needed to open this trade. And then over in column P is when the trade is closed, I'll put in what the exact amount is that I actually netted from the trade. Column Q shows me the percent of the maximum dollar that I did net out of all potential premium that I could have gotten. This just shows me how much of that I actually took in. So in this top cell here, you can see I took in 93% of my max profit on this trade, but that's not usual. Here is 45 and 47 and 44 and 60%. So this tracks all of that. Column R tracks what my actual ROI is on this trade. So how much did I net relative to the capital that was required that I put up? And you can see these numbers are not too bad. They're 36, 15, 34, 45, 21%. These are all percent of return in the space of 1 to 3 months, which is not bad. And then column S, I track how many contracts I put on this trade, have an idea of how much I'm using, and I can use that to create averages and so forth. And then column T is the actual date that I closed this trade. And then therefore column U shows me how many days I actually held this trade. And then I can use this in all this information that I track. I can use it to create statistical averages, so I kind of have an idea of what's going on. And then over here is a bunch of those averages, which I will get to in a couple of minutes. Those are the columns that I use in this particular spreadsheet for this particular account. And we'll come back here and I will go through some of the trades one by one. So in total, I have 37 closed trades in this account since August 1st, 2024. And then I have 4 additional trades that are still open and working out, and they won't close before August 1st, 2025. They'll close later. So 37 trades were closed, opened and closed. I'll walk through just a couple of them here, and you can look at them closer if you decide to download a copy of this. So we'll just start with the very first one. I opened a trade on August 1st, 2024 on 6E, which is the Euro US dollar future. My put call strikes were what we see here, and the expiration date was 11/8. This was a little bit wider in terms of my days to expiration, so I had 99 days here. But I was just trying to play it conservative and get things started in a kind of a conservative way. My percent of holding time was 84% of the 99 days. My POP at open was 91%. IVR was at 77. And the maximum premium that I received on this trade was $825. I was targeting $412. And it required that I have $2,124 of capital to open this trade. I opened it with 3 contracts. And so when I actually closed the trade, my net profit on this one was $768. So you can see that I achieved 93% of my max. And I only held it that long because the trade just was going nowhere, which is great for a strangle. And I just kind of let it ride while a few other trades were going. It wasn't causing me any real threats. My ROI on that trade was 36%, and I held it for 84 days. So 84 days with a 36% return is not too bad. Closed it on 10/24, as you can see here. The ones you're probably interested in are my losses. I took 4 losses during this last year, and most of them were my fault. And we'll talk about the first one here. I opened a trade on August 2nd. In 6A, which is the Australian US dollar. These are my strikes. Expiration 11/8, again, 99 days to expiration. Probability of profit was 90%. And I took a loss on this one of $791. Why? Because I had overextended myself early in the game here with a number of trades. And as I had mentioned to you earlier, if you're trading a strangle, the amount of capital required tends to rise as the trade evolves. And in this case, my margin became smaller and smaller, and I wasn't watching this as close as I should have as I was focused on other accounts that I trade. And this kind of came up and hit my margin ceiling. And so the broker automatically closed the trade for me, regardless of where I was sitting, positive or negative. And so it closed this trade at a negative 791. And at the same time, it closed it on October 1st. And at the same time on October 1st, it closed this trade as well automatically for me at a negative $50 amount. So $50 loss on that. And it was completely due to not watching how much margin I needed to keep these trades open, I could have managed things, but that was completely my fault. So, because I just was, I had my attention fractured into other places. So this could have been avoided, but nonetheless, the overall annual returns that I received from this account still included these losses. So these two were my fault totally. The rest of these are all wins. Here's another loss. Again, it's on the euro dollar. This was open December 6th, and with 63 days to expiration. These were my call strikes, and I held this trade for 39, basically 40% of the 63 days. And I took in a maximum amount of premium of $1,214, and but this trade was a loser as well. And the reason this trade lost is because, again, I had a couple other trades going, and the margin headroom got really, really tight. And I wanted to keep some of these other trades going that were more profitable. And so I made the deliberate choice to just close this trade off to free up some of that margin headroom. So I was happy to take a $150 loss in order to keep some of the more profitable trades alive and working. And that actually worked out. I'm not one, I'll say this now, I'm not one to drastically roll and adjust strikes and all that kind of stuff. And I can tell you with this account and with all of these 37 trades, never once did I roll or adjust any of the strikes on here. I just set them and I let them work out. I either took profit at 50% or let it run a little bit if it was going fine, or I took a loss. But I wasn't going to play the rolling game where I kick the can down the road month after month after month just to kind of break even. I'd rather just cut the trade, take the loss, and start a fresh trade again. I know a lot of other people, do the rolling adjustments and all that, and they're good at it. And there's nothing wrong with that. For this kind of trading, I don't usually do that. I just would rather just cut the trade off and start over again. Anyway, that was a deliberate loss that I took. And the last loss that I'll talk about here is really interesting because this was on live cattle. I opened it May 1st. These were my strikes. I had 36 days to expiration on this one. Again, usually I look for 45 or more, but just depending on the time of the month, you might not be able to find contracts that, have 45. It might be way out beyond that. And so I chose this one, was the closest I could find to 45 days at the time. Let's see. Yeah, I held this 100% of the time. So here's the interesting thing is on this trade, I took a $2,600 loss. And it was so interesting because with live cattle, I had my puts and calls appropriately set, and the price was cruising straight down the middle for the entirety of the trade, the entire time of the trade. I held this to the very last day. So how many days? 36 days. So I'm at day 35, and the price is absolutely down the middle. Neither call is being threatened in the slightest way. I have had my eye on this trade, and I thought I'll just let it go to expiration. I'll just let the puts and the calls expire worthless, and I'll just keep the 20. I'll just keep the 400. But here's what happened on the very, very last day, on the day of expiration, the price was right down the middle of this strangle, going nowhere. I thought for sure that this was just going to expire worthless, but for some reason, some catalyst or hit the live cattle market, and the price absolutely exploded and just barely over my call strike. And there was nothing I can do at that point to really adjust things, and I just had to take it on the chin. So that was what that was about. So, and again, my mistake. I should have just done what I usually do, take it off at 50 or 52%, close the trade out way earlier, get it off the books. But I didn't. And this is what happens. The longer you hold a strangle is the Greeks will start to creep in, and gamma will start to creep in. And so it'll begin to magnify your losses at the very end, even though theta is increasing, gamma will sort of just really magnify those losses. So when this thing exploded, it really did a number. However, those were my 4 losses over the entire year. And so I'll switch over here and we'll take a look at the averages that came out of that. In column W here, we have the average hold time in days. So of all the trades we took that were closed, which is again 37, the average hold time is 29.5 days. The average DTE at trade open is 58.83, so that's right in alignment with my 45 to 60 day preference for DTE. 100% of profit outstanding. This just shows me what maximum premium is for trades that I have not closed yet. So those are those ones at the bottom that you can see are still open. And same with the 50% of profit outstanding. So if I closed all these at 50%, but those are trades that are still open. This is the average capital required per one single contract. On average, comes out to be almost $1,100 of capital for every one contract. So the average net profit per trade for all trades that are closed is $565.91. Again, this account started with $20,000 even. The total booked profit from all these closed trades is $23,971.74. So the total return on that is 119.86%, 120%, basically 1 year's worth of trades, 37 trades with an account starting at $20,000. The average IVR per trade is 44. The average ROI percent per trade comes out to be 20%. Not too bad, 20% ROI on trades that average a hold time of 30 days. The average percent of the max profit that I've been taking, and this includes the losses, is 30%. So instead of 52, I've actually on average been taking only 30% and still have come out with 119% return on this year. Now, if I exclude the 4 losing trades and I look at just the winners, well, then the average percent of max profit on the winners is close to 60%. But of course, we need to factor in the losers too. And so 30% is what I've been taking there in average max profit. Total percent of winning trades, 89.19%. So just about 90% of my trades were winners. Annualized ROI is 119.53%. And that's because we're just, it's almost the same as the return because we're, as the date of this filming, we're so close to being at the 1 year mark. So not too bad. My average win amount is $838. My average loss amount is $921. And my average monthly income, losses included, was $2,179.25. Not too bad, a couple $1,000s a month on average on a $20,000 account. Actually, though, I can tell you these statistics are in alignment with the same statistics that I keep on accounts that I've been trading for years, and they all come out about the same. About 30-day hold time, I get about a 93 to 110% annual return on those accounts. Percentage of winning trades is right around 90%. So all of these statistics are in alignment with accounts that I've been trading for years. To me, there's really no surprises here, but these are actual numbers based on actual real live money trades that we took in this account over the last year. I hope that it gives you some encouragement to know that this kind of return is possible for an account this size. And I encourage you also to keep very close, detailed track of all of your trades so that you can keep track of your statistics, because the more you understand your own personal statistics, the more confidence you'll have when entering a trade, the more peace of mind you'll have when you know you need to let a trade work itself out a little bit farther, particularly if you're early in the trade. and you know that your average hold time is about 30 days, it makes life a lot easier. It's okay. I've got time. I'll just let the trade work out. All right. So what's next? Well, I'll tell you, I've been trading this particular strategy on many of my much larger accounts for a long time, years. And the statistics that we see in this particular example are in alignment with statistics I already knew and have known for many years. But now that I've shown that this is a viable trading method, even for an account this size, the plan is simple. That is, scale. That means that we're going to gradually increase the size as the account grows, from 1 lot to 2 lots and so on. As the account grows, we can put on maybe 1 or 2 extra trades and diversify even more, and we just continue to scale up. So if you're someone who works a full-time job like I do, this style of trading actually is really perfect. You don't need to stare at charts all day. Most of these trades took just a few minutes to set up and research, and they required just occasional monitoring. I'll glance at it a little bit throughout the day. But for the most part, you can set your trades to start and you can set your trades to come off automatically. And you really don't have to watch them like, day traders do with all the anxiety and frustration that goes with that. All right. So in closing, here is the recap. $20,000 grown to $43,000 in 1 year. 100% return, slightly more. Nearly a 90% win rate. Steady monthly income. And I did it without stress, without drama, and without trying to be a hero. And I also still work full-time as a surgical nurse, although probably not for much longer. If you've ever wondered whether you can trade options with a small but reasonable account, now you know you can. So if you found this video helpful, hit that like button, subscribe, drop a comment below with your questions. I do answer all of them. You may want to also check out my other video where I explain in open detail how I screen for my cash-secured put trades. I show my screening criteria, I show how I filter the data in Google Sheets, and how I arrive at trades that have juicy premium. So thanks so much for watching. Check out my options trading course at www.thejoyfultrader.com. And I look forward to talking to you more, helping you to achieve your options trading goals. Trade wisely, live fully. I'll see you next time.